So we are now in Chapter 12. The first thing to learn about Chapter 12 is remember that you are in Chapter 12 and not Chapter 10 or 11. In Chapter 12, we're going to be investing in bonds, debt investments. We're going to be investing in stocks, equity investments or stock investments. This is going to be very different from what we did in the past two chapters. In Chapter 10, we did our liabilities, and so we issued bonds payable. Our company paid dividends, and we did all of the interest expense and interest payable, all of that. In this chapter, we are now the company who is buying the bonds that other companies have issued. So we are on the other side of the market here. So the debt investments to us are an asset. We've invested in the bonds of another company. We are going to receive interest revenue on those bonds. Okay? And when we get to the stock investments, you have to keep that separate from what we did in Chapter 11, where we issued stock. Our company was issuing stock, we were paying dividends. Chapter 12, we are now buying the stock issued by other companies. To us, it's an asset, it's a stock investment, and we're going to receive dividend revenue. Okay, so that's the first main point. The other thing is just on when we get to accounting for our investments in debt and stock securities. For some reason I cannot understand, Wiley removed transaction costs from all of the homework and from the text. You need to know these transaction costs, because when you actually are accounting for stock, whether it's your own or for a company that you work for, these transaction costs make a difference in the taxes that you pay, and it makes a difference in the accounting. So, for no additional charge, I have put the transaction costs back in to all of the lecture material on this and any of the examples I do. Your assigned homework will not have them because it's from the text and I can only do so much. So, but you should be aware it is important enough that you are aware of these that I did go to the trouble of leaving them in or putting them back in. The other thing, on Learning Objective 5, you're going to run into a couple of different ways, a little different terminology. Since your text has been published, the available for sale category is now called non-trading. I'll accept either on the exams, but non-trading is the more current terminology on that rather than available for sale. And then the other is the debt securities that are formally called held to maturity. They just changed it for held for collection. And again, either terminology I will accept. It's not that big a deal, but you need to be aware. I'd just like you to be up to date on what the current terminology is. Okay, what else about the chapter? Okay, as far as accounting for debt investments and stock investments, I would encourage you to look at the What You Need to Know section and just go through that to get familiar with some of the terms as you're going along. And I'd highly encourage you to look at the outline and organization of the chapter I provided, because it can be a little bit confusing. The first study objective is just why corporations invest in debt and stock securities, and that's, that covers both debt and stock securities. When we're accounting for debt investments, we're going to use what's called the cost method. And anything in this chapter is going to seem like a piece of cake after Chapter 11. So this is not a real heavy-duty chapter, at least not compared to 11. So with your debt investments, we'll do the cost method. You remember that debt investments, they have no vote. These are so there's no control of the company you've invested in. And how we account for the different items in this chapter depends on the economic reality underlying the situation. So if there's no vote, no control, we use the cost method for all of our debt investments. When it comes to stock investments, each share has a vote. So that means that depending on how many shares of the company you own, you have either no control, maybe some control, or total control. So we're going to have three different ways of accounting in case, for each situation. Where there's no control, we're going to also use what's called the cost method, which is the same that we would use for our debt investments, because they also have no control. If you have some control, in other words, maybe you own, 20 to 50% of the stock of another company, you've got enough votes to influence their policies a bit. And so in that case, we're going to use what's called the equity method to account for it. And then if you have total control, if you own 51% of the stock or more, then we're going to be filing consolidated financial statements. And you need to know that that's what happens there, but we do not do consolidated financial statements at this point. So we'll be doing the accounting for no control and some control, the cost and equity methods. You need to be aware that consolidated statements would be filed if there's 51% ownership or more, but we're not going to do them. So I guess that's the good news there. And I think that that's probably good enough for introduction to this, and you'll get a lot more detail as we go along.